we are going to start accounting rate of return as our next topic. Okay, is that clear, everybody? Okay, so quickly, the accounting rate of return, or the ARR, expresses the average accounting profit as a percentage of the capital outlay. Okay, it expresses what? Average accounting profit divided by the capital injection, the cost of the project or the cost of the asset. Okay, so it's very, very, very similar to ROCE, return on capital employment. Return on capital employment is PAT, profit after tax, all over capital employed. So this time around, the only difference is the denominator. Yeah? The denominator will always be the cost of the capital or the initial injection of the project. Okay? So this method is simple and is a familiar thing to us as accountants. So what decision rule do we have to advise? Decision rule is that projects with an accounting rate of return above a defined minimum are acceptable. For example, if the organization's policy is they don't implement projects that are below 25% ARR. So that means if any project hits 25% and more, the project will be acceptable. Okay, so that's the decision rule. Okay, advantages of ARR, it's quick and simple to calculate. Of course, like I said, it's a familiar concept to us as accountants, and we're using accounting profits. It can easily be calculated from our financial statements. That's another advantage. It looks at the entire project life, okay? Unlike the payback period, which looks at only the periods within the payback, and it does not consider cash flows after the payback period. This one looks at the entire project. So it has disadvantages. One serious disadvantage is because it is calculated on accountant's profit, it is subjected to a lot of different interpretations. Like I said, some accountants use straight line method in calculating depreciation. Some use weighted average. Some use reducing balance method and stuff like that. Even if you use the same method, for example, reducing balance, your assumptions may differ. For example, the useful life of your assets, the useful life of your furniture and fittings, SDF might use 10 years, and maybe the Gambia Hotel and Multimedia, whatever, may use 5 years. So it depends. So because of that, accountant's profit is subjected to a lot of potential manipulation. Okay, the fact that it is a percentage is a relative measure rather than an absolute measure. Hence, it takes no account of the size of the investment. Okay, it's always calculated on percentage basis, and it takes no account of the length of the project, and like the payback period, it ignores time value of money. So since it's not a DCF technique, it ignores time value of money. Okay. So now, how do we calculate accounting rate of return? There are two possible methods. First is the simple method, and the second one is the average method. Okay. So the accounting rate of return methods appraising a project involves what? Estimating the accounting rate of return that a project should yield. If it exceeds a certain target, like I said, then you implement. Okay, so the two different methods are the normal method and the average method. So you have the normal method, you calculate your average accounting profit, that's the average by years, divided by your initial capital outlay. And the second method is the same numerator, but the denominator is different. The denominator will be average investment. And average investment is usually calculated as the initial investment plus the final investment, which is usually the scrap value or the salvage value, as the Americans will call it, divided by 2. It's that simple. So these are the two methods. But in exams, you will be told what method to use in case it appears. Okay, so we have this question. A project involves the immediate purchase of a plant costing 110. It will generate annual profits before depreciation of 24,000 for 5 years. Scrap value will be 10,000 at the end of the year. Okay, this is a simple one. So what we're going to do is we are going to do a more complicated one. So this example 2, please do it on a do it as part of your assignment. Sorry, example 1. Do example 1 as part of your example 1 is very easy. So we're going to do example 2, which is a bit more complicated. Is that clear, everybody? Example 1 on ARR will be one of your assignments. Are you with me? Are you with me, class?
Yes, we are with you, yes.
Okay, good.
Yes.
So I'll just go to a sheet called ARR, accounting rate of return. Example 1, EG1 will be assignment. Okay. Very simple, but just do it as part of your assignment. So all assignments are supposed to be done on only one workbook. Please take note of this. I don't have time to look for different workbooks. Okay? The file you created initially, the Google Sheet file you create initially is the same file that you should do all your assignments. Each assignment must be done on a fresh worksheet. Okay? Take note of that. So example 1 is an assignment. I'm going to make it bold so that you can see it clearly. Right, so let's go to example 2. Okay, example 2 starts here. Okay, so example 2 says, arrow once, and this example 2 is on page, let me tell you what page it's on your handout. Take note, I have given you a handout, and I've also given you your lecture slides, so make reference to them. This one, the ARR. Okay, so example 2 starts on page 5, okay, at the bottom, and it continues on top of page 6, just for your reference. Right. So I'm going to read. Please make sure you screenshot it if you haven't got it. Okay, screenshot it so that we can walk through it smoothly. Aaron wants to buy a new item of equipment. 2 models of equipment are available, one with a slightly higher capacity and greater reliability than the other. The expected cost and profits of each item are as follows. Capital cost is 100,000 for X and 175 for Y. They have the same useful life. Profits before depreciation are this. Disposal value of equipment. Accounting rate of return is measured as the average annual profits divided by the average investment. Okay, so that's the method they want you to use. So you've been told to use what? The average method. Fill in the boxes below to determine which equipment item should be purchased if the company's target ARR is 25%. So 2 equipments, 2 projects. equipment X and equipment Y. You need to assess and calculate their accounting rate of return and compare them to the company's target, which is 25%. Okay, is that clear? So this is what exactly we're going to do. Everybody, are we together? So first, I want to ask, what profits are given in this question? Are they cash flow or they are accountant's profit?
They are cash flows. Huh?
They are cash flows. Okay, they are cash flows, we agree. In calculating ARR, do we use cash flow or we use accountant's profit? In calculating ARR, accounting rate of return, do we use cash flow or we use accountant's profit?
Accountant's profit.
We use accountant's profit. But we have not been given accountant's profit. What we've been given is cash flow, that's profit before depreciation. Yeah. So what do we do to calculate the accountant's profit?
We depreciate.
We depreciate. Good. We depreciate. So the profits we have not been depreciated, so we need to depreciate them. Simple. We need to depreciate them. So take this, screenshot this, then we're going to move to our worksheet. Excellent. So I'm happy that you're telling me what I want to hear. So this is called what? Interactive question 1. Interactive Q1. Right. So we've been given a box to fill, isn't it? Okay, we've been given a box to fill. And let's produce the box. So it's going to be what? I'm going to expand, isn't it? I'll have as my first column my details, then I'll have item X. Item X and item Y. Just going to duplicate this and I'll change the X to Y. I'll change the X to Y. Okay. Right. So first things first. So what do we have on the template? The first thing that should come on the template should be what? Profit before depreciation, isn't it?
Yes.
Profit before depreciation. Okay, and next should be what? Yes.
It seems like you are doing the answers, but you are not projecting it.
Oh, you are not seeing it? Is that so? Oh, I'm not projecting it. Yes.
We are looking at the question, but not your worksheet.
Oh, well, I'm sorry about that. I'm sorry about that. I should have changed Yeah, you're right. You're right. Sorry about that. Let me just, yes, you're right. I forgot to project it, yeah. Don't worry, I'll just do it in a sec. Okay, good. Excellent. Can you see it now?
Yeah, it's loading.
It's loading, huh? You can see it clearly now.
Yeah, I can see it.
Clearly, huh? Okay, excellent. So you can see it clearly. I made it, I zoomed it so that you can all see it clearly. Right. So, so item X, item Y, then we have our depreciation, we have our profit before depreciation. So the next one on our template is what? Profit after depreciation, isn't it?
Yes.
So say profit after depreciation. let's have all our templates. Let's put our templates. Let's put our frame. Then after we can plug in the numbers. Then the next is average annual accounting profit, isn't it?
Yeah.
Average annual accounting profit. Average annual accounting profit. Let me just expand it a bit. Okay. And the next line is what? The average investment. Average investment. Okay, we have average investment. Good. Then at the end of the day, we are supposed to get what? Our ARR. Okay, and this will be based on the average method. Just put based on average method. Good. Okay, so far so good. Am I making sense? Are you following?
Yes, yeah.
Excellent. So we got our table. Now let's populate the numbers. The first one we have is going to be the profit before depreciation. Okay, so let's go back to our question. The profit before depreciation, we have it over 5 years, isn't it? So we need to add all of them for each equipment. Okay, so let's add for X from year 1 to year 5 is going to be how much? 50 plus 50 plus 30 plus 20 plus 10 is how much? Is how much?
180.
Huh? 50 plus 50 plus 30 plus 180. Is that correct, class? 180?
Yes, it's correct.
Check it properly. It's not 180.
160.
Yes.
160, correct. Mr. Core, you are adding the last 20,000. The last 20,000 is the scrap value.
Yes, yes, sorry.
Okay, excellent. So I'm going to format this. Financial, and I'll reduce the decimal places. I align them because they are numbers to the right. So correct. So there are 160,000. What about for Y? So I add the cash flows before depreciation from year 1 to year 5 for Y. How much? How much? I'm waiting.
280, please.
280,000.
280.
Correct. 280,000. Now, we have to calculate our profit after depreciation. Okay, but before we calculate our profit after depreciation, let's first add a column and put that as the depreciation. So we're going to use, not a column, sorry, a row to calculate our depreciation. And mind you, this will be our total depreciation for 5 years. So what's our total depreciation for the 5 years for X? Okay, when you read your question, you are told that the cost of the capital is 100,000 and 175,000 respectively. And their useful life is 5 years in each case. And the scrap value for X is 20,000 and the scrap value for Y is 25,000. So what's the total depreciation for each of them? Can someone tell me how we're going to calculate that?
You open bracket.
Okay. I say equals, I open bracket,
100,000 minus 20,000.
100,000 minus 20,000.
Close the bracket.
Close the bracket.
Divide by 5 years.
I divide by 5 years. Is that all?
That is per year, multiply by.
That's per year, yeah?
Yes, and multiply by 5 years.
Multiply by 5 years.
Oh, sorry. Yeah, that's per year, depreciation.
You know, divide by 5 years, multiply by 5 years is nil.
Is nil.
If you do that, of course, it's going to be correct. We have to put our bracket close. We have to do our bracket here, and we say multiplied by 5. So that will give you 80,000. Of course, 80,000 is correct. But is the method correct? Why do you have to divide it by 5 and you multiply by 5? You know, divide by 5, multiply by 5, the effect is 0. Do you know that?
Yes, it's 0.
So I'll tell you, look at it. If I remove this, and I remove the extra bracket, what did I get?
Same, the same. 80.
The same. Okay, and it's simple. The logic is simple. If you buy equipment X for 100,000, okay, at the end of the 5 years, you can be able to get only 20,000 as cash back. That's the scrap value. Then that means what's the total depreciation? The total depreciation is the difference. Okay?
Yes, that's true.
In an asset, there are 2 things there. Okay? In an asset, you have 2 things there. The depreciated amount and the scrap value. So if it costs 100,000 and at the end of the day, scrap value will be 20,000, whatever remains there is the amount that have been depreciated over the period, the accumulated depreciation. Okay, so the accumulated depreciation over the 5 years is 80,000. Simple. Okay, so what about for Y? Equipment Y?
150.
So we say equals, give me the formula. Bracket opens.
175,000.
175, 1, 2, 3. I hope the rest of you are understanding, yeah?
Minus
I hope the
25,000.
rest of you are understanding.
Minus 25,000.
Yes, yes. Yeah, minus 25,000. Okay, these are very, very simple things. And now you will have total depreciation of 150,000. So now what is going to be the profit after depreciation? We deduct it, isn't it? So we have 160 minus 80. We enter and we replicate this way. So your profit after depreciation or the accountant's profit will be 80,000 and 130,000 respectively. Okay? So now we want to calculate our annual accounting profit. So let's have some workings here, or we just have some assumptions written down here. So what's the life of the project?
5 years.
The life of the project is 5 years, so we type 5 here. Now I want to show this 5 to read 5 years so that I can be able to use it in calculations. Can someone take me through how to do my custom number formatting to do that? Karamo, you want to try?
Yes, I can try. Yes.
Okay, yes.
You can say equals to.
A custom number formatting equals to.
Okay, custom number format. Sorry. Sorry. You go to formats.
Okay, I have to first click where I want to custom format, yeah?
Yes, you go to format.
I go to format,
Custom number format is down there.
Custom number format down here. Minto? I cannot see it here. Yes.
Go to number. More formats.
More formats.
More format, okay.
Custom number format there.
Custom number format. So what do I do next?
You click on 0, 0.
I pick on 0. The reason why I want to pick on 0 is because I want my years not to have any decimals.
Yes.
Okay? Equally, if I pick this one, it's also fine because this one, in case the years are more, I'll have a 1,000 separator. So I can choose this one. So let's use this time around. So what do I do next, Karamo?
You put inverted commas.
I put double inverted commas. Please, inverted commas are two. You have double inverted comma and you have single inverted comma. Their functions are different.
Okay, double inverted comma.
Open.
Double, then space.
I hit the space bar once.
Then you can type yes or month, whatever you want to type.
I'm going to type yes, that's what I want.
Then you close the inverted comma, the double one.
I close the double inverted comma. And then look at the sample. If you see this sample working here, that means you are correct. Look at the sample. It has given you the sample. Okay? 1 comma, and then you have in years. Then I click on apply. Excellent.
Apply,
now look at it. It has given me 5 years. Okay? So now I'm going to use these 5 years to calculate my average annual accounting profit. So can someone help me? Wait, I have to select someone. Salimatu Balde. Salimatu, I want to calculate my average annual accounting profit. Give me the formula that I need to put on C9. Salimatu. Salimatu, are you with us? Usman Jai. Usman, today you've not been active. What's the problem? Usman, are you with us? Okay, right. Madeline, Madeline. Madeline Jabang. Madeline? Mohammed Gay.
Yes, Mr. Fufa.
Yes, Madeline. Okay. Give us the formula that we need to put
Hello?
here. Yes, Madeline?
Mr. Fufa.
Yes, Madeline, we're hearing you. Can you give me the formula that I need to put on C9 to calculate my average annual accounting profit for item X? Madeline, are you having network difficulties or what? Musa Tarawale.
Hello, Mr. Fufa.
Yes, Madeline.
Hello?
Yes, take us through. We're hearing you, Madeline. Yo. Musa Tarawale. Kumba Fayinke. Kumba, Are you a sister to Mariatu Kumba? The Fainkes. Kumba. Mariatu Fainke? None of the Fainkes are answering. Ali Tala. Ali? Okay, now, who can tell me what formula I should
I can
put?
try. I can try.
You can try.
Yes.
Yes, go ahead.
Equals to
Equals,
C8
equals, I click on E8,
C8 divided by C15.
divided by C15.
Yes.
Okay?
And
Huh? I enter.
yes, enter, yes.
Okay. Then what do I do next?
You replicate to the other item.
I replicate. Okay, I've replicated. This is what I got. Is this correct, Mr. Kaur?
No, that one is not correct, sir.
It's not correct. Why is it not correct?
Oh, okay, no. Okay, for that one, also, that one you have to. Okay, for item Y,
Mm-hmm.
you should have locked the C15. You have to lock C15.
I have to lock C15. Correct.
Yeah.
That's the way we do. Because we are using only 5 years here. We are not putting it in
have to lock C15.
other cells. Okay. We've discussed it many times. Okay, so we're going to lock C15. So to lock C15, we press F4 whilst we are on edit mode. Now we can duplicate this, and it's going to give us any error message. So it's correct now. So the average annual accounting profit is 16,000 for X and 26,000 for Y. Now, what about the average investment? Okay, so I'm going to put scrap value here. I'm going to put scrap. So what's the scrap value for X?
20,000.
20,000.
20,000. What about for Y?
25,000.
25,000. Okay, so now can we calculate our average investment? This side is the working. So can we calculate our average investment? And of course, we can put our initial investment also here, or the cost of capital. We say capital cost. We can type it here, it doesn't matter. The capital cost is 100,000. 100,000 and 175,000. Isn't it?
Yes.
Okay. So now that we have all these facts, can we calculate our average investment? Can someone give me the formula to calculate the average investment? Atta Njai, Atta, are you with us? Atta? I'm going to make this bowl and I give them a different color because I'm going to use them. Okay, so the average investment, can someone try? Anyone? Karamo? Batu Drane.
Yes.
Okay, so you want to try. Okay, Mr. So, yes.
Yeah, we are dividing the
Mr.
cost of capital by the scrap value, right? That is, equals. If that is the case, it equals, no?
Equals.
Yeah, C17.
C17, which is the cost of the capital.
Yeah, divided by the scrap value.
divided by
C16.
C16.
Yeah, we
Is
enter.
this correct? Is this correct? Class, is this
Mr.
correct?
Fufa.
No.
It's
Should
not
be
correct.
C15.
Should be.
No, 15 years.
Okay, Madeleine, you want to try? Now that you are back,
Yes.
Madeleine, you want to try? Give us the formula.
Yes. C17
Equals
equals, yes.
C17,
Plus C16.
plus C16,
Then you divide it by 2.
divided by 2. Enter. Okay, is that correct? Is that correct? Is this correct? Is this correct?
Zavona, explain please. I have zero idea.
Huh? You have what? Is this correct? The average investment. It's not correct because of the formula. Madeleine, you have an idea, but we did not follow board mass. And as such, what the system has done for us is that it has taken C16 divided by 2 plus C17.
Yeah, the bracket.
Yes. So you should put a bracket before the divided by. Correct.
Before the divided.
Correct. Now it's 60,000. Correct. So we just replicate. So we have this 100,000. So we have 60,000 and 100,000. Now, what is our average account? What is our accounting rate of return based on the average method? So I'm going to replicate this format. So can someone give us the formula to calculate our average accounting rate of return? Sorry, our accounting rate of return based on the average method. Okay? So far, so good? Mohammed Koka. I'm sure Koka just logged on. He's not been active today. Mohammed Koka?
Yes, Mr. Fofana.
Yes, what's wrong with you today?
I have bad connectivity.
Oh, bad connectivity. Oh, too bad. Sorry about that.
Yeah. What was your question again?
We want to calculate the last one, which is the ARR. We've got our average annual accounting profit. We've got our average investment. And we all agreed that the annual
Yeah,
the accounting
rate of return based on the average method. I think it would be the average annual accounting profit divided by.
So I'm going to put the formula here. So I'm going to put it as A for average, A for annual, A again for accounting, P for profit, divided by
the average investment.
A for average, I for investment. So
this
is our formula using the average method.
Average method, yeah.
Okay. So I'm going to wrap this up. I'm going to wrap it up. Okay, so I can fit here. Now, Can you tell me the formula that we need to use to calculate our ARR for X and for Y?
Yeah, it's going to be C9
equals
C9.
We're going to say equals C9, which is the numerator,
yes,
divided by
C10.
C10. We enter. But that has given us 0. We need to format it to percentage. Okay, if we format it to percentage, it has given us 26.7%. Then we replicate. So that has given us 26.00%. Okay, so now what will be our conclusion? Our target ARR as given in this question is 25%, but we have 26.67% for X and 26% for Y. And mind you, these two projects are mutually exclusive. So what do we do? What do we do?
Yes. We have to go in for project X.
We will go in for project X, item X. Why? Why are we going to go in for item X?
Because it has cost higher.
Return is higher than the project Y.
Okay, because item X has got an accounting rate of return higher than item Y. So therefore, we're going to execute item X, okay? These are mutually exclusive projects, and as such, we can do only one. So the one we're going to do will be the one with the highest returns. Okay, assuming that they are not mutually exclusive, we can do both because both of them meets the requirement of our company, which is 25%. Okay. So any questions? To be honest, accounting rate of return and payback period are pretty easy. And in exams, they don't usually come on their own. Forget it. You can never have a question separately on payback period or on accounting rate of return. They will mix it with other questions like NPV method and IRR method and stuff like that. Okay. So, but they are good stuff to know, and they are very useful in initial screening. So both of them are used for initial screening. Okay. You want to go for a project, you're planning to invest, okay, even at personal level. First, look at your payback period. How long will it take for you to get your money back? Okay, and then 2, what will be your return? Okay, so that also measures profitability. This accounting rate of return is a good method, except that 1, it does not put time value of money into consideration. Okay, and then 2, it's calculated on accounting profit rather than cash flow. Okay, and like I said, accounting profit is subjected to a lot of manipulation. Okay, so this is where we're going to stop for today, and we'll continue tomorrow, inshallah, at 3 o'clock. When we come, we need to discuss about the exam date, because our plan is to complete the syllabus by Tuesday, inshallah. Okay. So any questions, please, before we wrap up? Any questions or any observations? We're all okay? Shall we call it a day today?
Yeah, it was a good lecture though.
Excellent. Okay. Thank you. I'm happy that you guys followed and you enjoyed. Okay. So see you tomorrow, inshallah. Thank you and have a good night.
Mr. Fofana?
Yes, sir. Mr. Coker?
You gave us an assignment, right?
Yes, I gave an assignment.
Yeah. What's the due date?
Good question. Right. Today, I usually do my Tuesday.
Tuesday. Okay. Okay.
June Tuesday. Yeah. What's the date on Tuesday? Can someone help me?
Okay.
What's the date on Tuesday?
14th.
Okay. 14th September 2021. Excellent. What happened to assignment? Okay. I just put assignment. Okay, so I think that's clear now. Wrap it up.
So that's example 2, right? We're gonna do.
Sorry. Right, sorry. No, it's example 1.
Okay, so we will do an example 1.
Yes.
Okay.
I did the second one with you. So.
Oh, okay.
Okay. Right. So this is it. Okay. Thanks for that observation. So any more things before we wrap up? Okay. So if there are no other things, have a good day. Have a good night, of course. And we see tomorrow at 3 o'clock, inshallah.
Okay, and Mr. Fofana, please send the video lectures.
It might not be today because, to be honest, I'm very, very hungry. I have to go home. Maybe tomorrow morning I'll send, inshallah.
Okay, fine. Thank you.